I'm Mehdi Amini, CEO of United Legacy, and I welcome you back to episode 19 of Behind the Curtain. As we navigate the complexities of our financial landscape, understanding the key economic indicators and trends is essential to building and sustaining our legacy. In today's episode, we have an insightful array of topics to cover. First, we'll dissect the CPI Index, diving deep into what it reveals about our current economic state. Next, we address the concerns of rising credit card debt, asking critical questions about its implications and long-term effects. Lastly, we then shift our gaze to mortgage rates and applications, looking at their impact on home ownership and the broader economy. Join us as we break down these important topics, providing you with clear insights and understanding. The Consumer Price Index report released on Wednesday offers a mixed picture on inflation. While underlying price pressures appear to be easing, August was a challenging month for Americans' cost of living. Why is this important? Policymakers often concentrate on the core measure of inflation because it provides a more stable view of the inherent price pressures in the economy. However, headline inflation, which includes factors like gasoline prices, directly impacts the financial health of the American families. Unfortunately, this is where the unfavorable news lies. By the numbers, the headline CPI increased by 0.6% in August, marking the most significant rise since June 2022. The main reason for the spike was a nearly 11% rise in gasoline prices, which alone contribute to over half of the total monthly growth. Energy expenses have influenced the cost for public transport and airfares. As evidence, transportation services saw a 2% increase in August, and airline ticket prices jumped 5% after 3 consecutive months of price reductions. The consequences of these shifts was a drop in inflation-adjusted wages. The real average hourly earnings decreased by 0.5% in August, ending a 5-month trend of growth according to this matrix. Positives. Highly likely that the Federal Reserve will not increase interest rates in the upcoming policy meeting. In conclusion, the latest CPI data suggests that inflation might be on the decline, paralleling a slowing labor market. However, this isn't much comfort for families trying to manage their daily expenses. As I've been giving counsel to so many Americans across the Pacific and Hawaii, which Hawaii was the 3rd most expensive city in the United States to live. San Diego was number 1, where I reside. I am here to tell you guys that here in the last 2 years, the conclusion of CPI indexes, I remember when CPI was at 9.1%. And we're trying to make sense of that. That 9.1% didn't mean that gasoline prices during the Trump administration wasn't at under $3. And now here in San Diego, I managed to almost pay $7 yesterday at the gas pump. $7 per gallon for gasoline. So my gasoline didn't go up just 9%. So how are we really calculating inflation? And so one thing we look at here at American Mortgage Bank as a mortgage bank is, you've heard a term, debt to income. Debt to income ratio is the most important factor we believe that Americans right now are having a tough time living due to the majority of the expenses not being the fixed expenses that are going up. If you look at inflation, if you're a renter and you're renting an apartment, inflation, rent has gone up in double digits. If you look at mortgage rates and you're a home buyer, inflation has hurt you with interest rates going from 2% all the way up to 7.25% today. So there's so many different expenses in our life. I would say the top 10 highest expenses for us on a monthly basis that I believe has gone up 30 to 40%. You look at food prices, you look at gas prices, you look at mortgage rates, you look at what happens when you go to an amusement park, you look to see what's happening with credit card debt. Life is getting more expensive. And so we talk a lot about inflation. We can get very technical on how we look at inflation and what these numbers really truly mean. But I want to kind of come down to earth here. And here on earth, everything has gone up. And income is really tough for people out there. If you have kids, I have 2 kids, a family, cost of living, private school, a lot of decisions to make. And so I'm here to tell you that this is where all of us, regardless of our situation, we have to take a close look at our strategy with our income and our debts and the expenses that we see coming. Expenses have gone up, and you need a plan and you need a strategy. And so we're going to bring a lot more data, but we want to be down to earth and talk practical with everyone across the country. We talked about inflation, and now I want to start talking about credit card debt. 2 years ago, interest rates were 2%. Everyone's house values were going up. And one of the questions that we would ask homeowners is, how are you doing with credit card debt? Or is there something you want to invest money into? And most people would say, I am good. I don't have any debt. My income's great. My house is going up in value. My investments are doing great. Interest rates are low, and no, I don't need to borrow any money. Well, credit card debt is increasing. So that's the facts. Americans currently face a staggering amount of credit card debt, amounting to $1 trillion. For the first time, credit card debt in the U.S. has surpassed the 1 trillion mark. The second quarter saw an increase of $45 billion following a first quarter where there was no change in the level of credit card debt. This stagnation was significant as it defied a trend spanning decades. Historically, since the initiation of the New York Fed report, credit card typically decreased in the first quarter every year, with only exception was in 2000 and 2001. Every subsequent year saw some reduction in the first quarter until now. This absence of decline might indicate concerning credit card debt figures for Americans in the coming months. With the current surge in credit card balances have grown by $175 billion since last quarter of 2021, the current debt is $104 billion more than the previous record set in final quarter of 2019, when the balance was at $927 billion. Given the continued rise in interest rates, inflation, and other various economic challenges, it is probable that credit card balances will continue to increase in the foreseeable future. Let's talk about mortgage rates and applications. I think this is a great time of year. We already covered debt to income ratios, inflation. We talked about property values. We talked about the $1 trillion in credit card debt. But for the last few years, we heard a lot about interest rates. Interest rates are at an all-time low, 50-year low. We have 2% interest rates. And now interest rates for the last few years have done nothing but went up, and I believe we're getting used to it. Look, interest rates were over 7.25. We can get very technical, and I can tell you that the market composite index, which tracks mortgage loan application volume, fell 0.8% on a seasonally adjusted basis from the previous week. Without adjustments, it dropped 12% week over week. Refinance applications saw a 5% decline from the week before and were down 31% compared to the same week only last year. Meanwhile, the seasonally adjusted purchase index rose by 1% week over week. However, without adjustments, the purchase index fell 11% from the previous week and was down 27% year over year. So for the 7th time in 8 weeks, we've seen a decline in mortgage applications, hitting a low not seen since 1996. This recent decrease was primarily due to a 5% fall in refinance applications, marking the lowest point since January 2023. The 30-year fixed mortgage rate climbed to 7.27% last week, a jump of 40 basis points from late July. Despite the rate increase, purchase applications saw a rise, boosted by a 2% increase in conventional loans. With the current elevated rates, refinance activity remains limited, and there's less motivation for homeowners to sell and then purchase another home at a steeper rate. And you know what? I don't even know why we even talk about it or talk about whether or not someone's going to sell their home and go purchase in this new market. If mortgage rates would be considered in our inflation talk, would you sell your property and go pay a rate 3 times larger than what you were paying? Of course not. So these facts that we're dealing with now are becoming a reality. The reality is that Americans across the United States of America, coming from a friend of mine at a credit union, said, Mehdi, we track these credit cards. And what we're starting to see is that the consumer is putting their normal living expenses on their credit card. And with interest rates rising, it just doesn't affect home purchasing or refinancing or your personal liquidity. It affects your credit card minimum payments. It affects when you want to go buy a vehicle and then you have to put gas in the vehicle. Just those practical increases has most Americans, when they're alone at home with their husband or wife, asking themselves a question: what are we going to do? In fact, a great mentor of mine used to say, we get the what's wrong with me. What's wrong with my job? What's wrong with my financial advisor? What's wrong with my real estate agent? What do I have to change? And the facts are that most of us, when we were getting the information 2 years ago, did not want to believe it. It's not about the economists out there or the professionals or the experts like myself that will bring you data and spell it out for you and tell you that, yeah, rates might get to 7%. What are you going to do? It's at the time that you hear it that you got to put the strategy and the plan together. And I believe interest rates will continue to rise, as I don't think short term they're trying to move them, but how much higher do you want these interest rates to go? Has it not already affected the liquidity market? Well, going back to the CEO of a credit union that told me, look, Mehdi, our consumers are now using the credit cards for their daily expenses, and delinquencies are starting to go up. And I don't have percentages for you, but what I am telling you is delinquencies are going up. People aren't looking to move or looking for a new home, and the brand new college graduates are having a tough time finding work, and it's very difficult for those in different parts of the country, see different numbers, but it's much more difficult post-pandemic to get people to show up to work and want to work with the younger generations. The older generation is thinking to themselves, what are we going to do with the Social Security check? People are living longer than they ever have. And so if you're 65 years old today, you have a 84% chance of reaching 85 years of age. You have 20 more years to go, and this is supposed to be the golden years. This is supposed to be the retirement years. My rich dad said when your monthly residual passive income surpasses your monthly desired lifestyle, you are retired. I have two words for you: cash flow. As I've been speaking across the country, I've been telling everyone, we have an income problem. So whether it's putting our money in a retirement account that's going to bring us cash flow, whether it's inflation, debt, interest rates rising, this is taking from us. This is taking from our retirement income. We have to develop a strategy. We have to have the elite advisor referral network, the best of the best experts, to bring us the most up-to-date data and information so we can make an educated decision for our family to survive what we're experiencing real time. Don't put your head in the sand. Believe me, I know that many business owners, real estate professionals, fix and flippers, so many different professions right now have to put the car in reverse and ask yourself a question: what are you going to do? What is your strategy? How are these facts and information affecting your lifestyle today? And what are you going to do about it? And we want to bring the answers to you if you're willing to be coachable and teachable. So we're going to get really practical with it behind the curtain. I know a lot of times I go over all these numbers with you, but I had an awakening of let's keep it real. Ask yourself these questions today. This is not a rehearsed speech for you, a lecture. You're not at a stake and learn. You're not talking to your financial advisor. How are things doing in your life? It is September. It's the last quarter of the year. What are we going to do for 2024, 2025, 2026, 5 years from now, 10 years from now? What are you going to do for your retirement? How you look at this world is going to change. It has already changed. Accept it to move forward in real time. Have positive attitudes. Don't get stressed out. Don't worry about everything. Don't worry about your retirement. Get around individuals that have real data that can give you real sincere advice and put your legacy in front of their own. This isn't a world we're walking into where people want to be sold by a financial advisor, by a CPA, by a real estate agent or broker. We all have them in our life. I own companies that are in these industries, and for the last 2 years, I've seen so many professionals give motivated advice that motivates their pocketbook. I believe that we have to go out there as educators, as professionals, and wake people up to the new normal, to the new America, to the truth and what it takes to actually retire. What is the US dollar going to do internationally? What is happening with China? What is happening with Russia? What is happening all across the world? What's going to happen to the US dollar? It's not just inflation that we're dealing with. It's not just real estate prices that we're dealing with. What it is that there has been an attack on being able to debt service, whether it's our households, whether it's the new car we're going to buy, or whether it's a real estate asset. When interest rates increase, when cost of living goes up, it affects everything. So as we wrap up episode 19 of Behind the Curtain, it's evident that the financial landscape, how fluid it is changing. And when we looked at the CPI Index and the implications, the average American family, it is daunting reality. It's sad. The credit card debt of $1 trillion, it's affecting people. Shifts in mortgage markets has affected many companies and professionals and consumers in the industry as banks don't want to lend. There's a macro vision that I'm trying to give you that builds the fabric. Our intention at United Legacy is not just to present these numbers and trends, but to deepen your understanding and empower you to make informed decisions. Whether you're an investor, doesn't matter to me, or a homeowner, or even a renter, or someone just trying to navigate through this life in modern day finance. Remember that knowledge is your most valuable asset. You know, I sat down with a billionaire last week, and it was a dream come true. I want to thank you guys for joining me. It's Mehdi Amini, and I was sitting down with a guy by the name of Ernest Rady, and he said, Mehdi, are you having fun? I had just realized that it's been over 30 plus years as a La Jolla boy, having the American dream, the California dream presented to me in reality, just seeing how people live. Here I was with a guy in Forbes 400 as the 156th richest person in the United States of America. And his question to me wasn't about all the regulations and investments. We talked about that, but he was asking me if I was having fun. And you know what? To be raw with you, I paused, because what we have gone through, what you have gone through, what the American people are going through today, this, what's in our thoughts is not fun. So I couldn't tell you today that I was having fun, as I couldn't tell this billionaire that I was having fun, because I'm not having fun. This isn't fun. The final destination could be fun, but talking about whether or not we can live long enough where our money doesn't run out is not fun when you're sitting down with a 90-year-old that cares about their legacy and their family, and they've worked their entire lives to be in this position. We don't know when our day's gonna come. We don't know when we're here or when we're not. And so therefore we have to live in that reality, and I wanna have fun with you. And in order to have fun, and in order to retire, in order to be in those positions where you're sitting down with these billionaires and you're learning from them, you have to be open-minded. You gotta be willing to learn something new. And there is no doubt that we live in a new America today. So make that informed decision, and I will see you soon.